our algorithms are working and determining and differentiating businesses within a class.
Yeah.
Our algorithms are not doing the work that NCCI and other rating bureaus do. They distinguish plumbers from contractors, from accountants, from roofers.
Yeah.
And they do a great job at that. They get all the data from the industry, but what they're doing is they're determining an average rate for the average plumber.
Right.
And saying that that's what the rate is. Now, most of the commercial insurance industry that sells workers' comp is then taking that and saying, okay, this is our rate for plumbers, especially at the small business end, right? There's the use of schedule rating is what it's called at the small business end is pretty limited. Some companies have thresholds of premium and so forth that they do. And even if they're using it in kind of these like sledgehammer type approaches where restaurants, if you're a restaurant that have been in business for at least 5 years and you haven't had any claims, you all get 20% credits, right? It just doesn't matter what else is true about you, you're just going to get a 20% credit on. And so what we do is we analytically assess the individual risk of the business relative to similar businesses in its class, in its geography, and other sort of relativities to create a much more granular and differentiated slope up through that schedule rating band. So most states have a plus or minus 25% schedule rating band.
Yeah.
So you can have a 50% variance across, overall off the base rate, plus or minus. And so what we're doing is we're using that whole band. And so fundamentally what the algorithms are doing is they are attempting to pick out businesses that have lower expected claim frequency in the next 12 months. Severity is challenging to predict algorithmically because it's very volatile. Obviously, there are hazard groups and there are other things that sort of likely severities or likely occurrence of high severity events. But we're focused most heavily on sort of capping the severity and just looking at the frequency differences. Yeah. And so that's how we are able to achieve a lower frequency than the industry average because we are picking those customers out. We are providing them with more competitive prices than is typical in the industry, which means we win those accounts and we fill our book of business with positive selection as opposed to adverse selection. And that's a very different way of approaching it than, the most traditional sort of insurance space. And when you grow that way, you actually do have an ability to grow very rapidly while maintaining good loss ratios, which is different than the standard way of growing very rapidly in insurance, which is here's everybody else's price level. We're just going to shift down and sell this price level. And so we're selling dollars for 90 cents or dollars for 80 cents. And that's how we grow.
Right. And just
here's everybody's price level, and we price sort of diagonally across it, and we sell this population. Hi, this is John Swigart. I'm the co-founder and CEO of Pi Insurance, and this is the future of insurance.